Nigeria's Debt Management Office has offered 3 new federal government bonds valued at 225 billion naira for subscription by auction. Seun Ameye, a fixed income trader at Citi Nigeria, joins me to discuss how the fixed income market is reacting to the auction. Thank you so much for joining us on the show today. Seun, let's talk about really the sentiments we are having in the market. Despite the auction, it's still some relative quietness playing out here.
Well, I would say it's more of being cautious. As you know, the auction happened yesterday. They did offer the 3-year, the 10-year and the 15-year bond, but the stop rates at those auctions was higher than market expectation, judging by the way the bonds were trading in the market. The 2025s, for example, closed at 13.5 stop rate. That was about 100 bips higher than the previous auction and about 50 bips higher from where the market was trading. So is the 2032s and the 2037s. So the market just trying to adjust to the new levels while looking at the future and trying to see, what will happen maybe this week or next week before we see a lot of activity. So being cautious is the right word to use.
Being cautious.
Yeah, cautious.
Okay. Yeah. Let's also look at some of the activities that played out yesterday. We look at overnight lending rates at 67 basis points increasing marginally, and then that's just about 10.2% in the absence of much of activities or outflows or significant outflows. Let's talk about that and how the sentiment also would likely trickle into the rest of the timeline we have here for the week.
Well, the rise in overnight rates is basically as a result of the auction we had last week, the FX auction that we had last week, and possibly some discretionary CRL debits. But really, at 10 points, at 10%, it's still benign for the market, really. So what's really driving the fixed income is just that cautious attitude, not really the overnight rate at this point in time. In fact, the overnight rate is supportive of some, of some rally, especially on the short end of the curve. But really, it's just been looking out for the week and next week and trying to see what happens. That's really what's really driving the fixed income market.
Okay, now, and talking about the fixed income market, looking at the treasury bill segment of the market as well, the contraction we're seeing there as well, how long do you think this would likely persist?
Well, to look at it, to predict where treasury bills end up, you have to look at the liquidity and you have to make a projection of the liquidity, especially the overnight rates and the cash you have in the system. Right now, it's still a little bit benign at 10%, but look at the projections into this week and next week. We have a bond auction settlement tomorrow that will withdraw liquidity. We have some coupons on Friday, but that's not much compared to the liquidity that's going out. And next week, we have an MPC, really. So really,
fingers really will be crossed.
Fingers will be crossed, and the market will still trade cautiously for now. So I think we stay around this level or trade sideways for now.
And in terms of playing pundit, let's also look at your forecast. Like you've mentioned, the Monetary Policy Committee meeting holding next week. What do you think would likely play out and how you think that would affect the market?
Well, let's take a look one by one at the factors that can affect their decision. We have inflation that has gone to 20.52 compared to 19.64 in July, August 20.52. We have a slew of MPC, of central bank meetings, Europe, Japan.
The U.S. Federal Reserve is meeting today and would announce its rate hike tomorrow. We're looking at about 75 basis points really.
So I would say that there will be pressure on the MPC to hike rates or at least sound very, very hawkish, really, given what we have in the economy. And 20.52 inflation, no matter how no matter how you push it, it's really high.
And then it's also a contentious issue when we're looking at whether or not this aggressive stance is reining in inflation, because this body language is not what we've ordinarily seen the Monetary Policy Committee take here within the country, wouldn't you say?
But they do take action in the market, really, to reduce the liquidity in the system in accordance with the decision of the MPC, really. I think the decision most people will be having is whether hiking aggressively will lead to contraction in growth. Well, good for the MPC. The Q2 GDP numbers was 3.54 compared to 3.11. So I think they will be content to continue with their targeted interventions in growth and employment generation sectors for now, while tightening monetary policy at the same time.
But still taking cues from what we also had from the International Monetary Fund Managing Director, Kristalina Georgieva, also saying that inflation is also tough. This is affecting the response to markets as well. And then we have to have a much more resilient and robust response as well to that. How do you think this would also pan out, really looking at the forecast, the longer term forecast of the market as we continuously see inflationary pressures increase?
Well, like I said, I think that will be up to the MPC, but my sense is that they will get more hawkish as the time goes by. The other thing to consider is that they will not want to be reactionary. You know, we have inflation going up. The electionary season is kicking up in full gear, really. You don't want the inflation to get to 40% before
Too
you start
overwhelming.
again. So most likely you see an aggressive response, or at least very, very hawkish.
Quiet tones also been observed in the equities market. Do you think the attractiveness of the fixed income market will still persist for a longer timeline?
Well, like I said, what we have in the fixed income market is what we call it yield hunting, right? Trying to find the best deals, you know. And I think that's what investors are doing for now, really. Just sitting back and trying to pick the best deals all over the world, really. So I think that will continue fixed income markets.
Okay.
Yeah.